Welcome back to my channel where we are going to be financially smart together. In this video, I'm going to show you how to calculate profit, loss, and break-even point, which is important because during your trading, your option contract will constantly change prices, and you need to know when to take profit and when to cut loss. Before we continue, please make sure you understand the basic concept of buying and selling a call and put option, which can be found in the video over here. For the examples that you're going to see, please note that I picked them at random and did not analyze them, so don't go placing these trades just because you see them in this video. Now with that said, we're going to use Microsoft options, and Microsoft is trading around $240 right now. In this example, we're buying a Microsoft call option expiring April 16, 2021 with a strike price of $245. And it's quoted at $8. So this gives you the right to buy Microsoft. And this is a profit and loss graph for buying a call option. In this example, your strike price is $245. So we're going to mark this strike price right here, $245. And an easy way to remember where to mark the strike price is where your graph changes directions. Since you're buying an option, the most you can lose is the amount of premium you paid for the option. And in this example, it's $8 per share. So you need to multiply $8 by 100 because it's 100 shares per contract. So that means you would have paid $800 for this option contract. To find the break-even point, it's the strike price plus premium. So it's going to be $245 plus $8 equals $253 as a break-even point. So we're going to mark that right here, break-even point, 253. An easy way to remember this is the break-even point is always going to be where your chart crosses the 0 point. Since you're buying an option, the amount that you can earn is unlimited. But for this example, let's just pretend that Microsoft increased to $260 on the day of expiration. So to find out how much you would earn in this situation, you would take the stock price, which is $260 right now, minus the strike price, $245, minus the premium, which is $8. And that would give you a profit of $7 per share. So your actual profit would be $7 times 100, which is $700 right here. If you sold the call option instead, then you have the obligation to sell 100 shares of Microsoft, and your profit and loss graph would look like this. Let's first mark up the strike price right here, which is going to be $245. And in this example, you're selling an option. So unlike last time, your maximum profit is equal to the amount of premium you receive. Now, this option is $8 like last time, so $8 times 100 equals $800 as your maximum profit. Your break-even point is the same as the last example. So it's your strike price, $245, plus premium, $8, equals $253. And we'll mark that right here, $253. Whenever you sell an option, your loss is unlimited. But let's just take the same scenario as above and pretend that by the time of expiration, Microsoft increased to $260. So your hypothetical loss in this case would be your stock price, which is $260 minus strike price, $245, plus premium, $8, which would equal to $23 per share. And that's 100 shares per contract. So your hypothetical loss would actually be equal to $2,300. In this example, we buy a Microsoft put option expiring April 16, 2021 with strike price of $235 and it's quoted at $7. So you have the right to sell Microsoft. And this is the profit and loss graph for buying a put option. The strike price here is $235. And your buying option, so your max loss is your option premium. So $7 times 100 shares equals $700. The break even for put option is your strike price minus premium. So $235 minus $7 equals $228 right here. And again, since you're buying an option, the amount of profit is unlimited. But for this example, let's just pretend that Microsoft dropped to $210 on the day of expiration. So $210. So in this case, your hypothetical profit is your strike price, $235, minus stock price, $210, and minus your premium, which is $7. So your profit in this case is $18 per share, and multiply that by 100 shares, which is going to be $1,800. If you sold the put option instead, then you have the obligation to buy 100 shares of Microsoft, and your profit and loss graph would look like this. Let's first mark the strike price, $235. And since you're selling an option, the maximum profit is equal to the option premium you collected. So $7 times 100 shares equals $700. So for the break-even point, it's the same as last example because they're both put options. So it's your strike price, $235, minus premium, $7, and that's going to give you $228 as break-even point. And again, since you're selling an option, the amount you can lose is unlimited. But let's just take the same scenario as last time and pretend that the stock fell to $210. So in this situation, your loss would be your stock price, $210, minus strike price, $235, plus premium, $7, and that's going to give you a loss of $18 per share. So your total loss would be $18 times 100 shares, and that's going to give you a total loss of $1,800. This is what the profit and loss chart looks like on Thinkorswim, and this is what you're going to see when you're actually trading. So what we drew out is related to this green line over here, and that's what happens at expiration. And this purple line is what you'll see before expiration when there's still extrinsic value to the option. I'm going to link the video that explains intrinsic value, extrinsic value, and what makes up option premium at the end of this video. Now you can see here that the break-even point, profit, loss is actually different before expiration date and on expiration date. So this is what it looks like to buy a call option. Now this is what it looks like to sell a call option. This is what it looks like to buy the put option in our example, and this is what it looks like to sell that same put option. As you can see, when you buy an option, your loss is limited to the amount of premium you pay for that option, while your profit is unlimited. And when you sell an option, it's the other way around, where your loss is unlimited and your profit is limited to the amount of premium you receive for selling that option. Which means it's very dangerous to sell a put option without having the money to actually pay for 100 shares of the stock at the strike price. It's also very dangerous to sell a call option without actually having 100 shares of the stock. With that said, most professionals sell options instead of buying options because most options expire worthless. And as you can see, the premium of an option determines your return. So check out the video on option Greeks so you can learn how premium are calculated. And put any questions you have in the comment section below. And don't forget to subscribe and hit the notification bell so you won't miss out on any future lessons like this.